Hey everybody, welcome back to Dividend Stockpile. Today I'm joined by Howard Chan, CEO and founder of Kurv, and it is the mind behind two of the firm's option-based ETFs, KQQQ, the Kurv Technology Titan Select ETF, and brand new KYLD, the Kurv High Income ETF. So we're going to talk about what inspired these ETFs, what sets Kurv apart from the competition, and what these funds are all about. So with that, Howard, welcome to the channel.
Thank you. Glad to be here, Jeremy.
Absolutely. So excited to have you here. Done a lot of research on these products, and I know they're very popular in the income community. So I'm happy that you guys were able to come on and talk through the details of these. If you don't mind, can you give a brief introduction on Kurv ETFs and yourself?
Yeah, Curve was actually formed because there was a rule change in the SEC. Many of us have worked at some of the larger asset manager firms like GSAM, Goldman, and PIMCO. And what we noticed in the market was because of this rule change, the team has run strategies for large pension funds, sovereign wealth funds, and endowments. And a lot of these strategies really they were not available for anybody who had a brokerage account. And because of this SEC change, we thought now we're able to maybe provide access to these strategies that have been used by the largest, investors in space, and then put it in a vehicle that is easily accessible in people's brokerage. So we went down that route. That was the original mission. But as we kind of went down the route, we noticed there was one thing we overlooked, which is that endowments, pension funds, sovereign wealth funds, they don't pay taxes. So we basically rebuilt all of these strategies to be as tax efficient as possible. And that's how we ended up with the mission now, which is that we want to make accessible tax efficient institutional strategies to investors of all sizes. And then we have some actual tax solutions as well that we also offer.
That's great. Yeah, the tax favorable treatment of the income coming from the ETFs because of the way the ETF wrapper is set up is such a huge benefit to individual investors. So with that, I know you guys have a suite of ETFs that you have out there, but today I wanted to talk specifically about KQQQ and KYLD. Can you give a very high level overview of each of those funds?
Yeah, I think I'll start with the premise of this, which is that many investors, including advisors and self-directed investors, have always had to make this trade-off between growth and income. So if you want growth in your portfolio, meaning technology stocks and other emerging technology, emerging high growth companies, generally they don't distribute dividends. So if you want the income, you had to underweight those, and then really the ones that are dividend stocks are, financials, utilities, and industrial companies, and they're energy companies, and they were the largest components of the Dow, and they no longer are. And so they're actually what we call the mature company. And it's because they can't grow anymore, they distribute a lot of their earnings out. Mm-hmm. So this trade-off between, if you want income, you basically need to invest in old companies. If you want growth, you don't get income. We wanted to make that trade-off a little bit easier. So what we have done is essentially look to create a basket of high growth stocks, and then use options strategies on top of it to generate tax efficient income for investors. And then so that basket determines what the difference between the Tech Titan strategy and the high income strategy. So the Tech Titan strategy, by its name, is that we tend to look to technology companies that are dominant in pricing in their industry. So these are the names that you can think of, which is Apple, Amazon, Tesla, Nvidia, which most of them don't distribute dividends or very low But it also includes other names like Nvidia, Spotify. These are technologies that's very dominant in their particular vertical. So that's what constitute the Tech Titan strategy. Okay. And then those tend to be, I would say, core holdings in people's, it's unlikely that it's not a zero probability, but very low probability that Microsoft is going to go out of business tomorrow, right? Mm-hmm. Then we had demand for something where we do want maybe a basket of emerging technology, things that are going to be coming up. These tech titans have been around for 30 years, right? We want something what is the next wave of going to be these titans? And that constitute a lot of the basket that is in the high income strategy. the volatility is much higher, but the income that's associated with that, those option strategies is also proportionally higher. And one of the things that we're doing essentially is we are turning the volatility of risk premia into income. And so many of these names are more volatile, so you're able to generate those tax efficient income.
That makes a good differentiating between the two. So the Titans one, which is KQQQ, is more of the larger tech names, the more established tech names.
Yeah.
The ones, to your point, are dominant in their industry. And then the KYLD is some of more of the up and comers or the next generation of these tech names that aren't those household names necessarily, but they have the growth potential in the future. It seems like a lot of your holdings are on the tech side of things, and so obviously that's where the volatility is, that's where the growth is. So it makes sense to focus on those. But as we've seen over the last couple of weeks, especially, tech has a lot of volatility involved in it. Yeah, things can go up and down pretty quickly. So how do you see, because you're focused on those technologies, how do you guys weigh the pros and cons, or the volatility, or the potential for negative downturns in your funds?
Yeah, and one thing just to say also, we look for places or asset classes that don't generate income. So tech is obviously one of them, but there's precious metals like gold and silver, which we also have strategies in. Now, in terms of the volatility of tech, we actually, I think the strategy benefits from a higher volatility in the strategy. And I'll give you a couple of reasons why. So if you take a look at our basket, let's just use Tech Titans as an example, right? It is the volatility of the underlying stock that gives us the premium in the options that we're able to distribute as income. Mm-hmm. So in actually a higher volatility regime, the technical term is implied volatility. So what the market pricing of volatility will actually go up. So you can actually clip more premium in those environments than otherwise. But I think maybe one of the things that differentiates Kurv from maybe other strategies that's out there is that we're not just straight doing a traditional, what they call a cover call strategy. So we're able to shift our risk depending on what the risk environment is. So mm-hmm. in an environment maybe where the market is sort of resetting and pulling back a little bit to reset the prices, we are able to buy protections in the funds to actually decrease downside risk or mitigate downside risk. And versus when the market has risk on, we can take advantage of a market going up. And what that results is actually, if you look at the volatility of the Tech Titan strategies, we're actually running at a lower volatility than, say, the QQQ ETF in the last month. So we're able to shift positions in different risk regimes. The other thing I would mention is also that, because we're not doing a straight cover call strategies, we are uncapped when the market risk is on. So what really differentiates Kurv is that oftentimes I think a lot of these income strategies, people accept that over a long period of time, these straight cover call strategies is going to underperform the underlying because you're trading some of the upside for the income. And we kind of didn't want to accept that. We want to give a little bit of both worlds where you give income and price appreciation. So you can see actually in the performance of Tech Titans, we've actually outperformed QQQ, which is I would say how we compare ourselves in terms of the risk that we measure, that we run.
Yeah, I saw that. That's really impressive that since inception, you guys have beat out the QQQ, which is, to your point, the benchmark for a lot of these tech-related strategies. I also see that you're beating out some of the other high-income ETFs like JEPQ and QQQI, which is, again, really impressive, and you're providing more income. So it seems like it's a really good package. And I'm now that you mentioned it, I think that having that flexibility in your option strategy definitely will make a big difference when it comes to what you guys are able to produce both in income and total returns. So would you say that's your biggest thing that sets you apart from some of the competition, is that flexibility in the option strategy?
Yeah, and the ability to manage risk within the portfolio depending on what market environment we're in. I think that's the key, that you are able to maybe decrease risk or adjust risk when the market is selling, like right now. But then, when the market goes up, if a train is coming towards you, you step away. You don't need to just do a cover call and cap your upside. Yeah.
Mm-hmm. Yeah, that makes a lot of sense. And I think we'll go into a lot of more detail later. But when you're doing option strategy, do you do it on individual names, or do you do it on the index, or how do you approach that?
Yeah, we do a mix. Typically, when we harvest income, we look at individual names, and we do that on maybe a weekly or monthly basis. But when we want to protect downside, so what are we protecting? Maybe a general sell-off of the market.
Mhm.
We will buy indices or a basket, or even puts on ETFs with other baskets of names. So that difference between buying individual names to clip income and then buying a broad market put or other strategies to protect downside really gives us that asymmetric upside and downside characteristic.
That's great. And obviously, that strategy's worked out with you beating the Qs and beating some of the other income ETFs that are focused mostly just on the covered calls. I guess with that, a lot of these high income ETFs or these options based income ETFs have come out over the last couple of years. And to your point, with the rule change, it allowed fund providers to do this type of stuff. But what a lot of people are negative about these types of products is the NAV erosion, or paying out more distributions than you're getting in, and so your NAV goes down. Or because you're doing a 30-day strategy or something like that, you're capping your upside, so you're always going to miss out. So what would you say, like, how, beyond what we talked about now, how do you guys make sure that that doesn't happen, or that you don't fall into the boat where your NAV is going down over time?
Yeah, from the very first ETF that we launched, our goal was always to give consistent income with a little bit of price appreciation.
Okay.
And the NAV erosion effect happens when um, the income you distribute is greater than what you are able to generate in terms of gains and option positions in your portfolio. So then, but essentially, you're returning principal in your distribution.
Mm-hmm.
The way that we manage this is that we don't overpromise yield. You can see that in products or strategies where we have a comparator, a peer, our yield is actually lower probably in some cases, and that's because that number is based upon what the market gives us, and we don't distribute more than what the market gives us. But internally in each strategy, we actually also try to manage that a little bit. We have this what we call an internal bank. So every month or every week you may get a little bit more or a little bit less than what the average premium that you're going to get, right? And so in the weeks that we get more because maybe volatility went up, we take some of that. Obviously, we distribute a lot of that, but we take some of that and save it into an internal bank, such that when there is a week or a month where you get less premium, we use the bank. So that helps us be more consistent in terms of the distribution that we have. But we always don't want to over distribute to lead to NAV erosion. And the key, I think, maybe evidence of that is all of our funds are launched at $25 per NAV, and that we've maintained, generally plus or minus $3 around there. So in many cases, much higher because we want to build a healthy cushion so we don't have NAV erosion.
Yeah, no, that consistent approach and that premium bank, if you will, is a huge differentiator. That makes a lot of sense. I do write options on my own portfolio on my own, and some weeks, to your point, you can get thousands of dollars in premium on an account, and other weeks you can get hundreds. So having that little bank to hold on to when you have the really good weeks makes a lot of sense, and it just smooths out the distributions over time. So that's a really good approach.
Yeah, and just in your example, right? So if you are targeting $1,200 a month, and your option only gives you 1,000, if you distribute that extra $200 have to come from somewhere else in the portfolio, and it's eating in your. So that's the effect of the NAV erosion.
Yeah, that's a great real world example of how that works. Is a lot of people are investing in funds like these and they don't truly understand how it all works. You see these 50% yields, 100% yields, but then the capital balance goes down over time. They don't understand why that's happening, and that actually makes a lot of sense. Okay, well, let's dig into the ETFs a little bit more. So let's start off with KQQQ, because that's the one that's been around the longest. That one was established back in 2024. So can you give a high-level overview of what that one is and maybe what the option strategy is, and as well as the distribution you guys have been able to produce?
Yeah, the way that we think about it's called the Tech Titans, and the way that we define Tech Titans is a company in which it uses technology to essentially dominate their verticals. And so what you have seen, and really in essence, is basically investing in monopolies. So a lot of technology companies, what happens is they are dominant in their particular vertical, right? Let's say Google search. And then most companies, as they grow, you expect their growth rate to slow down because they've become larger and larger part of the market, and they should slow down because there's nowhere to grow. But technology companies have actually grown like 20% over the last 20 years. And the reason why is because they become dominant in their vertical and they move to the next adjacent vertical and they became dominant on it. And then oftentimes they set their prices in, for instance, Google with search and then ads and then now cloud, right? So they keep going on the adjacent. Same thing with Amazon, retail, then AWS. So essentially what that strategy is looking is to buy those incumbent tech titans, not just in the AI space. It's like I mentioned, Netflix dominant, right? Streaming, and then everybody else trying to catch up, and the whole industry is consolidating, right? So that's what we call tech titans. And so we generally pick a basket of those, and we're actually what we call exchange agnostic. Oftentimes people buy, say, the triple Qs, and that's actually only the names that are listed on the NASDAQ exchange. We look to Spotify, which is listed on the New York Stock Exchange, etc. So we don't care where it is in the world as long as they have a dominance in their particular vertical. And then we use options to either get exposure or to generate income on these strategies. We have been able to, the latest distribution rate is about 17, 18%. Which is pretty healthy. That's what the volatility gives us in terms of that strategy. And we've been able to, I think, outperform the triple Qs by 4 or 5% since inception. One of the things to mention, I kind of alluded to it, is sort of the tax treatment. So in the fund, we're able to manage the taxes, both tax loss harvesting and to do in-kind trades within the fund, such that we typically we generate a return of capital. So typically when you get some cash flow from your investment, it comes from interest payments on a bond or a dividend distribution from a stock. Those are taxed at ordinary income, which is like your paycheck. Mm-hmm. For option strategies, you can get what capital gains, which if you have long-term, it's a preferential treatment. But we do one better, which is if we're able to manage the capital gains within the funds properly, we generate a third kind of distribution called return of capital, which is not immediately taxable. It goes to decreasing the basis. And you can compound that over time without every year having a slice taken out for tax. You only realize the gains when you sell the security. So that could be 3, 4, 5 years. Yeah.
Yeah, and at that point, because you've held the fund for so long, if you do sell the fund, you're going to get long-term capital gains taxes on that instead of short-term income like you would if you had to pay for the options on a weekly or monthly basis when they're received. Yeah, so the return of capital in a options ETF basis is actually a good thing that helps out. And yes, the tax loss harvesting as well helps with that tax bill. So some of the holdings right now, you mentioned all the leaders of their groups, but you have Alphabet, Amazon, Apple, Broadcom, Meta, NVIDIA, Netflix, and Tesla. So to your point, dominant in their industry, growing well over time, and to your point, is like almost a monopoly in their niche, if you will. So that all matches up really well. And then when you're writing options, you said you can write it on individual name or the indices. You can change it up depending on what you want to focus on.
Yeah, so we're using, there's 2 ways to decrease exposure in the risk-off environment. So you'll see some names we have cover calls. That's the first way. That decreases your exposure to the underlying. And the other way is to just buy straight out puts. You'll see some mags, puts, etc., to mitigate downside. So we use both to actually manage a portfolio in the current environment.
Nice. And I love the fact that you guys have that flexibility. So you're picking the individual names and you're also picking the option strategy. A lot of the other ETFs out there just do an index and then they do a 30-day call and that's their entire strategy. You guys have a lot more flexibility, both underlying as well as the option strategy to make the most of each market environment that we're going through. And over the last 2 years, the market has been on quite the roller coaster, lots of ups, lots of downs, and every week seems to be different. But having that flexibility to change your strategy or adapt your strategy to what's going on in the market goes a long way. And again, the results have proven it. And then you have a brand new one that was just launched at the end of October. So your Kurv High Income ETF, KYLD. You mentioned a little bit at the beginning, but can you give a little bit more detail on that one?
Yeah, so this one is what I previously described as more emerging names, things that are up and coming. They tend to be more volatile, and therefore, proportionally, we should expect more distributions from this ETF. Here we have a few different themes paying out in the basket. One is AI infrastructure, but unlike the tech titans where we have the big incumbent names like Google, right? Let's say, what is AI infrastructure? The chip makers, the cloud providers, right? Those are things around, not anything but the model, basically, right? Mm-hmm. So in the tech titans name, we have NVIDIA, those like Microsoft, Amazon for AWS, incumbent names. But because we're looking for emerging names in the high income strategy, we tend to be more satellite names like AMD, Broadcom. And the reason is because they have more room to catch up to NVIDIA. So their growth potential is higher than where NVIDIA is. I mean, it's, NVIDIA is like 5 trillion. Can it get to 10 trillion? That's going to be almost impossible, right? So that's how between the two funds or the strategies, the positioning is different, even though the theme might be the same. There's other themes that's playing out, which is precious metals. We think the debasement trade is not over, so we look to have gold and silver. We express it in the miners because they're a little bit of a levered play on gold and silver. And then we have other things that where companies with a network effect, APP, payments companies that we think these are incumbent. They're at the end of the day, good business or business that generating a lot of profit. So we're not just buying like speculative names that who knows will pan out in 5 to 7 years. And then maybe the other theme is we do have some Web3 Bitcoin exposure, which right now is having a little bit of trough, but those assets tend to have cycles. So we think that will benefit over the long time. And all of these names have very high implied volatility, which helps us generate the income. And now the distribution rate on this particular strategies is about 30-35%. Where we are starting, which is commensurately higher than the tech titans, right? Because the underlying portfolio is also much more volatile. Yeah.
Yeah, that makes a lot of sense. To your point, the more volatility, the more premium you can get, the more you can pay out. So just talking about some of the holdings, you mentioned a couple of them, but Teradyne, VanEck Gold Miners ETF, the Silver Miners ETF, Howmet Aerospace, Shift4 Payments, Intel, and Vistra are some of the other top 10 that you didn't mention. So it gives you a sense of what kind of names you're picking. One thing I really thought was quite interesting with this particular ETF is your payout schedule. Can you talk about that and why you chose what you did?
Yeah, we're always trying to meet our investors where they are. And we know a lot of folks use some of these strategies to supplement cash flow, or they have a very sophisticated reinvestment program. And so Tech Titan distributes on a monthly basis, but the high income strategy distributes actually on a weekly basis. So the frequency higher, so people can do with what that distribution that they want.
Yeah, that's great. It's great to give people options, not just focus on the quarterly distributions or even the monthly. Now you have the weekly, so it fits in different investors' profiles and needs. On KYLD, is the option strategy very similar to KQQQ, where you have a variety of options you can pick from?
Yes. So we have the same flexibility, and the toolkit is almost exactly the same between the tech titans and the high income. We could do straight cover calls. We can do put spreads, call spreads, different depending on the environment for the individual name. So that flexibility allows us to manage the risk that's in the portfolio. And we can also buy, protective puts if the market is, selling off. So, yeah.
So I really appreciate you talking through it. If you could give someone maybe like a quick summary of like why someone would consider either of these funds, what would you say to someone quickly?
Yeah, I think for the Tech Titan strategy, it's something that you can put as part of your core, part of your portfolio, and it could pair up with other equity dividend ETFs so that you can have the exposure to U.S. equity markets. And it's meant to be, the names in there is meant to be ones that are generally stable, even though there might be recent volatilities. And then I would say that high income strategy is more of a satellite strategy in which you want to have higher yield, but it's a little bit more volatile. But in both strategies, I think the big takeaway is that we want to make sure you get both good and consistent income as well as price appreciation on the NAV that you have in the strategy. So we will try our best to balance both. And then we would look to guard against NAV erosion on both.
All right, so where can people find more information about these two ETFs as well as the rest of your suite of products?
Yeah, if you want to find more information about the strategy, you can go to our website, kurvinvest.com, KURVINVEST.com. We also have, we're also on X. And if you're interested in our views, we have a podcast called Curve Your Enthusiasm. So that sometimes is fun. We go on into rabbit holes on that.
That's cool. I'll definitely make sure I put all the links to all that in the description as well as on the page here. All right, so Howard, thank you very much for coming on and talking to us. We're talking about the Kurv Technology Titan Select ETF, KQQQ, and the Kurv High Income ETF, KYLD. Thank you again, and we'll hopefully be able to talk real soon.
Thank you. See you again.
Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.